What's up, guys? How we doing today? Today we're talking about the real reason why most traders lose all their money. And no, it's not because they don't have the right strategy, per se. I'm going to break down some numbers here. I'm going to go behind the details on why most traders fail, and then I'm going to show you how to build a system that keeps you in the game long enough to get good at this. Okay? Not expert, but good enough to survive. No fluff, no theory, just actually what works. And yes, I did use ChatGPT on this because there's no way I can keep track of everything I'm thinking of for this video. Okay, the real statistics. Ready? So everyone's heard the stats, right? 90% of traders lose money. Let me show you why that is. Okay, and it's not what you think. Number one, okay, there's actually 4 reasons why they lose money. Number one is over leveraging. Okay, there is way too much for that trade. 10%, 20%, sometimes even 50% of their account on one position. That's financial suicide right there. One bad trade and you're done for. 2 out of 4. No stop loss or moving stops. I watched some videos yesterday on YouTube of these trading fails, and I think it was actually pretty funny. Not a single one of them had a stop loss. You're just asking for it. And if you did lose money without using a stop loss, not because nobody taught you how to use a stop loss, but because you're too arrogant to learn how to use a stop loss, then I'm not gonna feel sorry for you. Okay, I'm just not gonna happen. I knew about stop losses on the first day I actually got serious about trading. Okay, number 3, revenge trading. Okay. You lost one trade and then you decide to enter thinking you're going to win that back. But guess what? Now you lost 2 trades because what happened to the second trade, you ask? You lost it because that was a revenge trading. You didn't prepare for this one. You prepared for this one. You will prepare for the second one. And then you got your number 3, 4, 5 until your account is blown in one day. Number 4 is over trading. Okay, let me go over what that means. Okay, over trading is pure greed, guys. Pure fucking greed. And I'll probably get censored for saying that. But on a most realistic scale, guys, as a trader, I'll do maybe 1 or 2 trades on that day. That's it. 1 or 2 trades. That's it. There is absolutely 0 reason for anyone to trade 10 positions that day. Okay, unless you are managing a fund. Okay, if you are managing a fund and you have 6, 7, 8, 9, 10 different accounts that you're managing with a very strict system and trade copier, then yes, that makes sense because 1 execution equals 10 executions. Okay, that's fine. That's not over trading. That's your professional career. I'm talking about guys who is out there revenge trading by tenfold, and they're just putting one trade in out to another and not know a damn thing about what they're doing. Alright? If you gotta notice something, right? None of these are about not knowing technical analysis. Most traders lose because of psychology and risk management. Okay, not because they can't read a damn chart. Anybody with a brain and some knowledge in technical analysis can analyze a chart. All right. Now, what about the psychology behind it? Right. So why do smart people make these dumb mistakes, guys? Because trading, it triggers every terrible survival instinct that you have. Greed, number 1. If I risk more, I'll make more. Fear. I can't take another loss. You know what I'm saying? So I'll move my stop. Give it some more room to breathe. Ego. I'm right. The market is wrong. Let me prove it. Let me prove it that I'm right. Yeah, you and that bank account. FOMO. Everyone's making money right now. I need to get in right now. That's your next door neighbor right now, talking to their buddies or their neighbor and their neighbors. Okay, they all heard about this one amazing stock that's going to take off and skyrocket and change the world for the better. Guess what? Unless you have a reason to enter that same position that your friend did, you just straight up gambling. Okay, you might as well just go to a casino, find your little sports betting spot. Okay, get yourself a nice drink and just chill out over there. Okay, leave trading to people who are serious about trading. Our brains are literally wired to lose at trading. We're wired for it. Now, check this out. Okay, think about this for a moment. What does your brain want you to do when you're losing money? I gotta get it back, right? Get it back fast. That's a huge no-no in trading. Huge no. That's called revenge trade. So you overtrade, you revenge trade, and you risk more than what you plan for that day. All right. Now, when you're on a winning streak, okay, your mind loves to mess with you. Okay, your mind messes with you on a daily basis when you're overthinking about something or doing this or that. But guess what? When it comes to trading, it's tenfold. All right. When you're on a winning streak, you want to protect it, take profit early, get scared. So you cut your winners short and let your losers run. It's the opposite. All right. You need to flip that mindset. Trust me, it took me a while to figure that out too. That's why risk management isn't optional, guys. It's the only thing standing between you and blowing your account. Rule number 1, never risk more than 1% of your account per trade, guys. 1%. Let me go over why. I don't care if you have $500, $500,000, or even $50,000. 1% per trade is all you need. With 1% of risk, you can survive 20 losses in a row. That's 20%. Okay, but just because you can doesn't mean you should. With 10% risk, 3 losses, and you're done for. Okay, I know 1% feels small. I know you want to grow fast, but here's the reality. Okay, you're not trying to get rich in one trade. You're trying to stay in the game long enough to compound over time. If your friend over there is buying 100 lots into a currency, you might want to ask that friend if he knows anything about risk management. $10,000 account, 1% risk per trade equals $100 risk. Okay, if you average 3% gain per trade, that's 1 to 3 risk award, and you take 10 trades a month with a 60% win rate. I got 75. 6 winners times 300 equals 6 winners times 300 equals 1,800. 4 losers times 100 equals -400. Okay, net 1,400 per month equals 14% monthly return. That's life-changing over a year, guys. Don't look at it as such small numbers. All right, the fact that you can get $500 out of the market and use that to pay your bills with, okay, think about that for a minute. That 1% is non-negotiable. Do not change this rule for anybody. Not your girlfriend, not your wife, all right, not your kids, nobody. Position sizing. Let me go over what position sizing is, okay? So you know you're risking 1%, but how do you actually calculate the position? How do you actually calculate the positioning size? Okay, here's the formula. Position size equals account size times your risk percentage divided by stop loss in pips. Sorry, was I speaking gibberish? All right. Let me break it down with an example, okay? I don't have anything on my board here because it's way too much work. I'm going over 18 different things today, and I seriously, I need a secretary for this. All right, if I was to write anything else on this board, I probably need a secretary. Here's the formula, okay? You have a $10,000 account. Take the number 10,000. You're risking 1%. What's 1% of 10,000? Rather than 10% of 10,000. 10% of 10,000 is 1,000. Right? Now, let's go back to my example. If you have a $10,000 account, you're risking 1%, which equals to what? $100. Your stop loss is 20 pips away. What does that tell you? $100, that's 20 pips. Each pip is worth what? $5. Each pip is worth $5. $100 divided by 20 pips equals $5 per pip. Now, if you don't know how to adjust your positioning size, please do your research right now. Okay, I don't care if you pause this video, do your research right now on positioning size, because that's the difference between a $5 pip value versus a $50 pip value, which is also 50,000 units, which is also 0.5 lots. Same account, $10,000, okay? 1% risk equals $100, but this time your stop is 50 pips away. Your stop loss is 50 pips away. Now, if you're only risking 1%, that's $100, right? Now, don't forget your previous position got you at $5 per pip. What's 50 times 50? That's $250, right? That's $250. That's already over. That's over your 1%. See? Now, what you need to do is take that $100 divided by 50 pips. Now that equals to $2 per pip. You got to remember to adjust your position size to 0.2 lots. I don't know if you guys caught on yet, but 0.5 lots is $5 per pip. 0.2 lots is $2 per pip. We catch him on here? Catch him on? No, what's 0.1 lots? $1 per pip. There you go. Okay? The wider your stop is, the smaller your position size. Please, guys, do not make that mistake. Okay? Don't be that dumbass that opens a position tomorrow and you forget to change your lot size from your previous position when you have 5 or 10 lots in the last position and your new one has a wider stop. Make sure you adjust that number. Keep in mind, you always want to risk the same dollar amount. But adjusting your stops is what makes the difference. Okay? This is critical, it's crucial. Most beginners trade the same lot size every time. On some days I do 5 lots, on some days I do 3 lots, on some days I do 2 lots. See? If you don't know how to calculate this, use a position size calculator. Okay, I'll probably find one for you guys and include it within this video. It's free, it doesn't cost anything. Okay, stop loss. All right, stop loss placement. Let me tell you guys. Let me teach you guys about how the stop loss placement works. So since now that we have the position size dialed in, okay, the stop loss is not just a random number of pips. All right, guys. It's not random, it's calculated. All right. In most trading platforms, right, it will give you a slider that you can use to adjust your stop losses. Right. This slider, it's very deceiving. Okay. Make one small move on the wrong time frame on your slider, it just made a difference between a $200 loss versus a $20,000 loss. Number one, here's how you guys do it. Okay, number one, below or above structure. If I'm going long, my stop goes below the most recent low or support level. I don't put it in an obvious support level, and I do not execute and trade until liquidity has been taken. If liquidity has not been swept, you do not enter. You can take that to the bank. I just give you something that most people wouldn't tell you. So you're welcome. Number two, give it room to breathe. Okay, don't put your stop loss 1 to 2 pip away from your actual entry point. You're just asking for this. Oopsie, I just tapped your stop. I just got your liquidity. I got your money. All right. Number three, never move your stop loss in the wrong direction. Okay, I've done that a couple times. Even as I wouldn't say a super well experienced trader, but I do have a few years behind my belt. Okay, even I make this mistake. Okay, let me tell you guys about this video that I saw last night. Right, it was a lady trader. Okay, she was trading, what was it, the NQ? She was trading NQ or something. I forgot which one she was trading. The price went all the way up to the next liquidity zone, right? But what her mistake was not putting her stop loss closer to the break-even point. Okay, Now let's take a look at this for example, right? Let's say that this, is your entry point right here, right? That's your entry. If your target is up here, you want to set your stop loss down here. All right. Okay. Stop loss down here. You only move your stop loss to break even to up here if the price target is all the way up here. You put your stop over here just in case it reverses. Okay. Risk reward ratio. What is risk reward ratio? That means if you're risking $100, you should be targeting at least $200 profit. Okay. Ideally 1 to 3 or higher. Why? Because even with the 50% win rate, you're still profitable. Let's do the math. 10 trades, 1 to 3 risk reward, 50% win rate. 5 winners times 300 equals to 1500. 5 losers times 100 equals negative 500. Net equals $1,000 profit. Okay, you won half your trades and still made money. That's the power of risk reward ratio. Okay, when I'm looking at a trade, okay, I ask, where's my entry? Where's my stop? What's my target? And why is that my target? If the distance between the entry target point, it's too close next to each other, I try to avoid that trade unless I know for a fact that, hey, I know I'm going to take PTP even though the R to R ratio is 1 to 2. Last piece of the system, guys, is the loss limits. This is what saves you from yourself on a bad day, on a bad trading day. Okay, set yourself a limit. If you lose 3% of your account in one day, that's your sign to turn your computer off and go do something else. 3% in one day is unacceptable. Okay, why 3%? Because if you're risking 1% one trade, that's 3 losses. That's 3%. Now, unless you break your 1% into half and half, you risk 0.5 of 1%, then yeah, you can take 6 trades to lose 3%. Because if you're risking 1% 2 trades, that's 3 losses. At that point, you're probably emotional. Okay, you're forcing trades, or your strategy just isn't working that day. Either way, get out. More trading is more damage. Same thing for the week. Okay, if you're down 5% for the week, all right, you're done. Stop trading until next week. You lost 5% already. That's 1% a day. You have used up all your losses in one day. You're done for the week. Okay, let's put it all together. Recap all this real quick. Why do traders lose money? Over leveraging, no stop loss discipline, revenge trading, over trading, and no edge. Okay, all psychology and risk management issues. How do you fix it? Build a risk management system. Okay, number 1, risk 1% per trade, always, or less. Number 2, calculate your position size based on the stop loss distance. Not how much you are extending that you want to lose, is how much you're going to lose, period. Not, my original stop loss is 500, well, I guess now it's 1,000. No. You're going to keep it at 500. Extend, okay? You're going to have a wider stop, but at the same time, when you're adjusting to a wider stop, decrease your position size. Decrease it. So if you were going on a 5-lot trade and you just move your stop loss, well, before you do that, because you can't change your position size after you move the stop loss. You got to do it before. Number 3, place your stop losses at logical levels, okay, below structure. Never move them in the wrong direction. All right. Number 4, only take trades with minimum 1 to 2 risk reward ratio. Okay, so number 4, only take trades with minimum 1 to 2 risk reward ratio. Ideally 1 to 3, okay, or even better. Number 5, set your daily and weekly losses. Remember, if your weekly loss limit is 5% of your account's drawdown, and you lose 5% in one day, dude, shut it down. You done for. You done for that week. That's backwards. Okay, your strategy gets you in the trade, risk management keeps you in the game. If this has helped you at all, or open your eyes a little bit, and you want to commit to a 1% risk right now, go ahead and comment RM. Okay, if you are committing to a 1% trade risk. Okay. If you guys have any questions, go ahead and comment it below or shoot me a text in Discord. Either way, thank you guys for watching. I'll see you guys in the next one.